Welcome to Lesson 8, the Asset Side Part 2. In this lesson, we're going to look at each and every component on the asset side. Let's get started. The first and the most important concept on the asset side is understanding current assets. Now, as per definition, current assets are assets that are expected to be converted to cash within 12 months from the date of the balance sheet. So whenever you're reading a balance sheet, the current asset component is very important because the more the current assets are, the more liquid the company actually is. So under current assets, we have several sub-assets. The first one, and possibly the most liquid asset, is cash itself. So cash includes cash in hand, cash in the bank, cash in deposits. All these are collectively known as cash for the purpose of financial statements. Second, accounts receivable. I think we've covered this concept briefly in one of the earlier lecture. Account receivable represents the right to receive money from the customers. So under the accrual basis, whenever you sell goods, you account for it as a revenue. So when you account for it as a revenue, to that extent in the future, the customer is going to pay you. And therefore, to that extent in the future, you have a right to receive money from the customer, which is recognized as accounts receivable on the balance sheet. So accounts receivable represents the right to receive money from customers for goods or services already provided to the customer before the balance sheet date. So we have cash. The second one is accounts receivable. The third one is inventory. In simple terms, inventory is a stock of material that a company has or a business has. It could be either in the form of raw materials. Raw materials are basic materials that are going into the finished goods process. Or it could be work in progress, meaning the creation of the final goods is still in progress. Or it could be finished goods itself, meaning the final product which is ready for sale. So inventory is also current asset because it is likely to be converted to cash within 12 months from the date of the balance sheet. And it broadly comprises of three things: raw material, work in progress, and finished goods. The last or the fourth type of current asset is prepaid expenses. So let me give you an example. Assume that you're paying money to a company in advance. You're paying rent in advance. These are classified as prepaid expenses, as the name itself says, because you're paying them in advance, and to that extent, you are likely to receive services in the future. The next concept is understanding the current asset cycle. We saw the four components of current assets. But now let us understand the current cycle using an example. So there is cash based on which raw materials are bought. In this example, I'm going to take the example of our good old pizza shop. So the pizza shop has cash. It buys raw material, which is inventory. It converts them into pizzas. Till the time it is converted, it is in work in progress. And when it is converted fully, it becomes finished goods. And these finished goods are sold to customer when it becomes accounts receivable. And when the customer pays, it becomes cash again. This cycle is called the current asset cycle or the cash to cash cycle. So a quick recap. Assets are things that are owned by a business. Assets are shown on the balance sheet side in the order of liquidity. Current assets are assets that are expected to be converted to cash within 12 months from the date of the balance sheet. And the process of conversion of one current asset to another is called the current asset cycle or the cash to cash cycle. Let's move on. The next item on the balance sheet side is other assets. Other assets are typically assets which are neither current assets, meaning they don't have a realization of period of 12 months or less, or they are neither current assets nor fixed assets. We'll get into fixed assets later, but an example for now is long-term investments. Next, fixed assets. Fixed assets are assets that are held for the purpose of production and not for the purpose of sale. Fixed assets are held for the purpose of production and not for the purpose of sale. So they include items such as land, building, furniture, equipment, computers, software, etc. Going back to the example of the pizza shop, inventory is purchased in the form of raw materials, it is converted to WIP or work in progress and it's sold as finished goods. So what are the costs that are associated with this process? At the inventory stage, the cost is the purchase of inventory. In the WIP stage, the cost is the power cost, the water cost, the repairs and maintenance and so on. And at the finished goods stage, it is the packing and handling charges, the transport and fuel and so on. But if you notice, there's a very important item that is missing in this whole process. It is the cost of the equipment that is actually being consumed in the process, or the cost of fixed assets which are actually consumed in the process. Now, as you know, in this case, it is the baking oven which is a fixed asset that is being used in the production process. And as you know, as you keep using the fixed asset over a period of time, there is a lot of wear and tear, and ultimately the asset has to be replaced. So therefore, this fixed asset is being consumed in the part of the production process itself. Generally, these equipments have a lifetime of 3 to 5 years. And it would not be fair to charge the entire equipment cost as an expense, since only a part of that equipment's life is being used in the production process. So, in order to factor in this wear and tear of fixed assets which are consumed in the production process, accountants came up with a term called depreciation. Depreciation is an expense on the income statement to factor in for the reduction in the useful life of an asset due to wear and tear and from use and passage of time. Therefore, depreciation is merely a book entry and there is no cash involved in this wear and tear process. Depreciation is applicable to all items except land, because land generally appreciates, or the price of land increases and does not decrease. So depreciation is applicable on all assets. Let's look at an example. Assume that this equipment is costing $6,000 and the useful life of this equipment is 3 years. The simplest way of computing depreciation is dividing 6,000 by 3, which gives an annual depreciation of $2,000. This method of accounting for depreciation is called the straight line method, whereby every year $2,000 is accounted as depreciation. So in year 1, the depreciation is 2,000, year 2 it's 2,000, year 3 it's 2,000, and from year 4 there is no depreciation because the useful life is 3 years. And therefore the accumulated depreciation is 2,000 the first year, second year is 2,000 plus 2,000 which is 4,000, and third year it's 4,000 plus 2,000 which is 6,000. So this accumulated depreciation is the cost of the asset which is consumed in the process of production, and therefore it is shown as a deduction in fixed assets. So accumulated depreciation is a depreciation that is accumulated over the period, and it is shown as the deduction from fixed assets, and that is why you have net fixed assets as G minus H, which is total fixed assets minus accumulated depreciation. So on the asset side, we have two types of assets: the current assets, which are highly liquid, cash, accounts receivable, inventory and prepaid expenses. Then we have other assets which are neither fixed assets nor current assets. And we have fixed assets which are assets used in the production process, which are shown net of depreciation, which is the estimated value of wear and tear that the business is producing to those assets.